Every single day, trillions of dollars change hands. Apple, Tesla, Amazon, Google, companies worth more money than entire countries, are constantly being bought and sold by millions of people around the world. And yet, most people have no idea how any of it actually works. They hear the words stock market and picture a room full of people in suits screaming at each other. Or they think it's something only the wealthy elite have access to. Neither of those things is true anymore. In this video, I'm going to break down exactly how the stock market works, from what a share actually is, to how companies go public, to why prices move up and down, to when and how you can trade. No fluff, no jargon, just a clear, honest explanation that leaves you actually understanding this. Quick question before we dive in. Drop it in the comments. Did you grow up thinking the stock market was only for rich people or Wall Street insiders? I want to know. Let's start from the very beginning. What is a share? A share is a piece of ownership in a company. That's it. When you buy one share of a company, you literally own a small part of that business. Now, the word stock and the word share are often used interchangeably. And for our purposes, they mean the same thing. Here's a simple way to understand it. Imagine a company is like a pizza. Let's say the whole pizza represents 100% of the company. The company has been cut into 1,000 equal slices, and each slice is one share. If you buy 10 slices, you own 1% of the company. Buy 100 slices, you own 10%. Now here's the important part. Owning those slices isn't just symbolic. It means you actually benefit when the company grows. If the company doubles in value, your shares also become worth twice as much. And if the company earns profits and decides to share them with owners, you get a portion of that too. That's called a dividend, but we'll cover dividends in a later video. So why do companies split themselves into shares and sell them to the public in the first place? That's where it gets interesting. Every business at some point needs money to grow. Think about a tech startup that has built an incredible product, but they need $50 million to scale it globally, to hire engineers, open offices, run marketing campaigns. Where does that money come from? They have two main options. Option 1, borrow it. Take a loan from a bank. The problem? Loans have interest, they have to be repaid, and massive loans for a fast-growing company can be crippling debt. Option 2, sell ownership. Instead of borrowing, the company offers shares, pieces of the business, to investors in exchange for capital. The investors give money now, and in return, they own a portion of the company going forward. This is a fundamentally different deal. The company gets the money it needs without any obligation to repay it directly. And the investors? They're betting that the company grows, because if it does, their ownership becomes worth far more than what they paid. This is the core logic behind the entire stock market. Companies need capital to grow. Investors want returns on their money. The stock market is the place where those two needs meet. So how does a company actually go from a private business to something you and I can buy shares in? This process is called an IPO, an initial public offering, and it's one of the most significant events in a company's life. Let's break it down. Before an IPO, a company is private. That means only a handful of people own shares. The founders, early employees, and maybe some private investors who got in early. When the company decides to go public, it works with investment banks to determine how many shares it will offer to the public and at what price. This is a massive process involving financial audits, legal filings, and a roadshow, where the company's leadership literally travels to major cities pitching the business to large institutional investors. On IPO day, the shares are listed on a stock exchange. And for the first time, anyone in the world can buy them. Now, what is a stock exchange exactly? A stock exchange is an organized marketplace where buyers and sellers come together to trade shares. The two most famous exchanges in the world are the New York Stock Exchange, the NYSE, and the NASDAQ. The NYSE is the largest stock exchange on the planet by total market value. The NASDAQ is known for being home to the world's biggest tech companies. Apple, Microsoft, Google, Amazon, and Meta are all listed there. There are also major exchanges around the world. The London Stock Exchange in the UK, the Tokyo Stock Exchange in Japan, the Hong Kong Stock Exchange, Euronext in Europe. But for most traders and investors starting out, the US markets, the NYSE and NASDAQ, are where the action is. Here's the question most people want answered. Why do stock prices go up and down? The short answer is supply and demand. But let me actually explain what that means for stocks specifically. Every stock on the market has a price at any given moment. That price is simply the most recent price that a buyer and a seller agreed on. When more people want to buy a stock than there are people willing to sell it, demand exceeds supply, the price goes up. Buyers have to offer more to convince sellers to part with their shares. When more people want to sell a stock than there are buyers, supply exceeds demand, the price falls. Sellers have to lower their price to attract buyers. But what causes people to suddenly want to buy more or sell more? This is where it gets nuanced. Dozens of factors influence it. Company earnings. Every quarter, publicly listed companies report their financial results. If a company earns more profit than analysts expected, investors get excited and buy. Price goes up. If the results disappoint, investors sell. Price drops. News and events. A CEO scandal. A product recall. A new breakthrough technology. A government regulation. Any major news about a company or its industry can trigger a wave of buying or selling. Broader economic conditions. When interest rates rise, when inflation is high, when a recession is feared, these things affect investor confidence across the entire market, not just individual stocks, and simply human emotion. Fear and greed drive enormous amounts of trading activity. When markets are falling, fear takes over and people sell. When markets are rising, greed kicks in and people pile in. This is something you'll understand much more deeply when we get to a video on trading psychology later in this series. The key takeaway here is this. Stock prices are constantly changing because human beings are constantly reassessing how valuable they think a company is. And that reassessment happens in real time. Every second, the market is open. Which brings us to something practical. When is the market actually open? If you're serious about trading, you need more than just knowledge. You need the right tools. At the DTCtools.com, we've built 3 professional-grade strategies: CCT, DTC, and DTC Precision Pro, each with its own trading view indicator, MT5 automated bot, and live signals group. Whether you're passing a prop firm challenge, managing a funded account, or trading your own capital, we have a system built specifically for your goal. No guesswork, no emotions, just systematic, rule-based trading, engineered for consistency. Follow us on Telegram, link is in the description, and use code TELEGRAM20 at checkout for 20% off your next order. Visit the DTCtools.com and find the tool that fits your trading journey. The DTC Tools, trade smarter. Unlike crypto, which trades 24 hours a day, 7 days a week, the stock market has set trading hours. For the US markets, which are the benchmark for global stocks, regular trading hours are Monday to Friday, 9:30 a.m. to 4 p.m. Eastern Time. That's New York time. Outside of those hours, you have what's called pre-market and after-hours trading. Pre-market runs from roughly 4 a.m. to 9:30 a.m. Eastern, and after-hours runs from 4 p.m. to 8 p.m. Eastern. During these extended sessions, trading is lighter and less liquid, meaning there are fewer buyers and sellers, which can make price moves more volatile and less predictable. For beginners, the most important thing to know is this. The majority of volume and trading activity happens during regular market hours. That's when the big institutional traders, hedge funds, and market makers are fully active. That's where the liquidity is. And liquidity matters because it means you can enter and exit positions quickly without having to accept a worse price. The market is also closed on weekends and on US public holidays, like Thanksgiving, Christmas, and New Year's Day. So if you're planning trades around economic announcements or earnings reports, always check the calendar. Now, I want to mention something important for those of you who are thinking about trading stocks from outside the US, which many of you watching this will be. You can absolutely access US stock markets through international brokers. The time zone difference just means your trading hours will shift accordingly. If you're in the UK, for example, regular US market hours would be 2:30 p.m. to 9 p.m. your time. If you're in Dubai, it'd be 5:30 p.m. to midnight. We'll go deeper into brokers and how to actually set up an account in a future video in this series. So we've covered what shares are, how companies go public, why prices move, and when markets are open. The last piece is the practical one. How do you actually participate? 30 years ago, buying stocks was genuinely complicated. You had to call a stockbroker, a licensed professional, who would place the order on your behalf and charge you a hefty commission for the privilege. Today, it's completely different. You open a brokerage account online. This can take as little as 15 minutes on your phone. Deposit money, and you're ready to trade. Platforms like Interactive Brokers, Webull, or eToro allow retail traders, regular people like you and me, to access the same markets that institutions use. Now, here's a distinction I want to make, because this is a trading education channel, not just investing education. There are two very different ways to approach the stock market. Investing is the long-term approach. You buy shares in strong companies and hold them for years, betting that the company grows over time. You're not worried about day-to-day price movements. Trading is different. Traders are looking to profit from shorter-term price movements, whether that's over days, hours, or even minutes. They're studying charts, analyzing patterns, timing entries, and exits. That's exactly what this channel is going to teach you. Both approaches use the same markets and the same instruments, shares. But the mindset, the tools, and the strategies are different. Over the course of this channel, you're going to learn everything you need to understand both, and eventually develop the skills to make informed decisions about which approach, or combination of both, works for your goals. Let's quickly recap what you've learned in this video. A share is a unit of ownership in a company. When you buy shares, you own part of that business. Companies sell shares to raise capital without taking on debt, and they do this through a process called an IPO, which lists them on a public stock exchange. The two most important stock exchanges in the world are the NYSE and the NASDAQ. Stock prices move based on supply and demand, which is influenced by earnings, news, economic data, and human emotion. U.S. stock markets are open Monday to Friday, 9:30 a.m. to 4 p.m. Eastern Time, and anyone with a brokerage account can participate. In the next video, we're going to zoom into one of the world's most traded markets, Forex. We'll explain how currency pairs work, what pips are, and why the Forex market is actually the largest financial market on the planet. If you don't want to miss that, or any of the videos in this series, hit subscribe now. There's no algorithm trick here. It genuinely helps. And if you want to stay connected with the trading community we're building, get updates, market insights, and connect with other traders who are learning alongside you, join our free Telegram channel. The link is in the description below. I'll see you in the next one.